In today's Market Pulse Snapshot, the one thing I'm focused on is this. What kind of deals are getting done this year in private equity and venture capital? It's true that the overall private equity and venture capital deal activity is running meaningfully below 2021 and 22 levels, but some deals are still getting done. So let's unpack where these fund managers are deploying capital this year. So first of all, in private equity, leveraged buyouts or LBOs have notably slowed. Of course, they accounted for 50% of private equity deal volumes in 21 and 22, but so far this year, they represent about 38% of the total. Of course, this makes sense and shouldn't come as a surprise because the cost of leverage has gone up significantly and the underwriting of loans by banks has shrunk. Instead, private equity managers are focusing on growth equity. There are 669 U.S. growth equity deals that got done so far in 23, which is 30% more than the 515 buyout deals done this year. This is a first, since we have the data going back to 2008. But this development again makes sense because much less leverage is typically employed for growth strategies, and secular growth in B2B services, tech, and healthcare is alive and well, so higher rates and slower overall economy shouldn't and hasn't been a deterrent. Now shifting to venture capital, the deal count here is down relative to the boomy pace of 21, but that perhaps is not nearly as bad as one might imagine. When comparing that to the 2019 deal counts, deal volumes represent 60% of that year's total. So what kind of deals are getting done in venture? Well, the appetite for angel and seed round deals has waned significantly. Venture deal flow activity has shifted from new startups into more established scale-up companies. For example, late-stage venture now makes up 30% of deal activity versus 25% in 2021. And finally, in terms of the type of companies that are getting VC funding, it is all about software. This sector accounts for 38% of deal count. That's maybe not anything new, and software has long dominated the deal flow count, but in terms of VC deal value, software has definitely picked up this year. It accounts for 47% of deal value in 2023 versus 34% on average since 2013. And when looking under the hood, of course, it is all about artificial intelligence. That's what's driving the interest in software. AI company fundings account for 69% of the top 20 software deals so far in 2023. And while the AI story has taken the public market by storm just this year, this has long been a theme in private markets. In fact, venture capital funds consistently invested in AI companies since 2014, ramped up significantly their investments in 2018, and as a result, today there are 60 times more private AI companies globally than publicly traded ones. So to sum it up, looking at the deal activity this year, which is dominated by growth and tech, to me, the lesson learned so far from last year and this year is this. As investors, we never want to give up on growth, especially in private markets. Rate hikes, recession worries, they come and go, but growth in tech is here to stay. And that's your one thing in private markets this week.